Good afternoon, everyone. I'm Michael Kimmel, RPB's Executive Director, and I'm thrilled to welcome you and thank you for joining us on today's webinar. Well, I don't know about you, but I hope you're able to enjoy what, at least in New York, appears to be like a spring day. And from what I hear, also in Toronto, where David Baskin will be joining us from. In addition to myself and Len, Chair of the RPB Board, joining us today are David Baskin, as I just mentioned, Chair of our Investment Committee and President and Founder of Baskin Wealth Management, and Chris Moore, Chief Investment Officer of Summit Strategies Group, RPB's outside investment consultant. Before we get started, just a couple of housekeeping items. This webinar is being recorded and will be sent to you by email and also posted on our website. And you can submit your questions at any time by clicking on the Q&A button at the bottom of your screen, and we will get to as many of them as we can towards the end of the webinar. Len will go over the agenda as part of his opening remarks. With that, Len, the floor is all yours.
Thank you, Michael. And let me say to our audience, on behalf of the board, we appreciate your efforts. And that is Stephanie Berger and continuing this outreach program to our participants. So let me formally say shalom, baruch haba. Let me add my welcome to you and perhaps your investment advisors, who are always welcome as your guests on these webinars. This is our continued, as I said, outreach to the participants of your pension fund. The agenda today is really centered around the major issue that's being voiced today, and that's volatility. Michael said you'll hear from David Baskin, Chair of your Investment Committee, and Chris Moore, the Chief Investment Officer of our outside advisors, Summit Strategies Group. Now, it's our intent today to better educate you as to what we see from our side going on in the investment world and how it could impact you and your retirement assets. As Michael has said, anytime you have a question, please click whatever you're supposed to click and enter it. We would appreciate it. Chris, why don't we have you start out?
Thanks, Len. So as you can kind of see from the agenda, the presentation's kind of segmented into a few things, of which up first is talking a little bit about a market update for Q1. Here listed are some of the things that the market paid particular attention to, and we'll go through these in a little bit more detail in subsequent slides as well. However, the equity markets, for a change of heart, actually saw a little two-way volatility, so kind of more of a return to volatility to the equity markets in particular. This was multiple catalysts, but first and foremost was probably kind of the rhetoric and potential concerns about tariffs, trade wars, and what that might mean for the market more broadly. In addition to that, we'll speak more about performance broadly speaking, but the relative trend for most markets continued with, on a global basis, emerging markets still outperforming the US or domestic counterparts, as well as technology stocks, growth-oriented stocks outperforming the more value-oriented stocks as well. In addition to tariffs and trade wars, the market continues to recalibrate inflation expectations and what that means for both fixed income as well as equity valuations and returns prospectively. And then lastly, not without noting, is that central banks continue to normalize monetary policy with incremental interest rate hikes and the continued decrease of quantitative easing or non-traditional policy measures. If we flip the slide, we'll take a quick look at kind of the return of normal market volatility. You can see on this bottom graph, 2018, this is the percentage swings over 1%, or what percentage of the time the market has at least a 1% swing. You can see on a year-to-date basis at 40%, it's more in line with historical norms, but is a meaningful exception or meaningful difference from kind of the volatility in 2017. 2017 was very unique in that it was a historically low volatility experience and a very good market. Now, with that as kind of our recent experience, the more return to normal volatility can potentially be unsettling, but it's worth noting that this is more in line with historical norms. And despite all the volatility we've seen on a year-to-date basis, markets, broadly speaking, equity markets, that is, remain relatively unchanged on the calendar year. Again, kind of highlighting a lot of the concerns were inflation and specifically trade wars. So trade wars, I think there's been a lot of press and obviously a lot of politicking and or talking points in regards to potential trade wars. But it's worth noting that obviously in Econ 101, most folks, if they had the pleasure of taking the course, learn that kind of tariffs and free trade, tariffs and anti-free trade were some of the less interesting ways to handle the economy. But of note is this graph on the bottom, is that this is the motivation for this quite probably is not economics. It's most likely political. As the current administration is gearing up for the midterm elections, you can see that they are often trying to think of policies, economic policies that are very perhaps advantageous to their base. So this graph kind of highlights that although globally and the U.S. in addition has been a beneficiary of free trade, it's all the gains have not been shared uniformly. This red line here shows the labor force participation for those 25 and older without a college education. You can see it's almost the exact opposite or inverse of this global trade volume index. So this is the kind of well-known or phenomena of some of these U.S. manufacturing jobs, and these blue-collar workers have been, to some extent, the loser on this free trade equation. With incremental tariffs, perhaps some of these jobs come back, and or more accurately, some of these voters are incentivized to kind of continue voting Republican. The next chart is, I think David's going to continue to highlight some of the values of diversification.
Thank you, Chris. One of the things that we've emphasized in these webinars is the importance of diversifying our investments among various asset classes. Typically, many investors think of asset allocation as choosing only among stocks, bonds, and cash equivalents. But of course, the investment universe is far wider than that, and the number of asset classes to which we want to be exposed is far wider than that as well. This graph, which we call the quilt, for obvious reasons, shows the returns over time on 7 different asset classes. The ones that are most familiar to most of us are, of course, U.S. equities, which is the white box. And you can see that we've had a pretty good run with U.S. equities in the last 3 years, 2015, 16, and 17. All positive returns, and last year, stellar returns on U.S. equities of 21.1%. And the other asset class to which we're all very familiar is in the sort of teal blue color called core bonds. These are the kind of government and corporate bonds that the average investor might buy. And you can see that their returns have generally been lower in the last 2 years. But of course, in the years when the stock market is horrible, bonds act as a stabilizer. And if you look at, for example, 2008, you'll see that bonds produced a positive return of 5.2%, while U.S. equities were down 37%. The entire point of asset allocation is to diversify portfolios, to provide them with some assets that go up while others go down, to stabilize them and produce good returns with less volatility. You can see that in 2017, the best asset class to own was emerging markets, which had a stellar performance of 37%, sharply in contrast to its performance in 2014 and 2015 when it was negative. And the other positive asset class last year was developed markets in Europe, the Americas, and the Far East, which had a 25% return, again in contrast to really mediocre returns in the 3 previous years. The point of the quilt is nobody knows what color is going to rise to the top in any year. Putting all of your chips in, for example, US equities or US equities and core bonds ignores the rest of the world, ignores a number of asset classes, which from time to time are stellar performers. And one asset class that I want to mention because it's part of our story this year are master limited partnerships, MLPs, which are the tan box, and which you will find in the bottom right-hand corner of the quilt for 2017, with a negative return, sharply in contrast to almost every other asset class. But you can see that in the year before, the MLPs led the parade, as they did in 2010 and 2011. And we'll have more to say about master limited partnerships in a minute. So the important point here, and one that we all need to remember, is a broad, diversified portfolio with exposure to a number of asset classes is going to have more resiliency, less volatility, and likely will have better returns over time than one that's less diversified. So if we could switch to the next slide, please. This slide shows you the actual investment returns for our managed funds, our Tier 1 products, from April 1st of 2017 through the end of March of this year. As you can see, the Capital Appreciation Fund, our most aggressive of our products, had a positive return of around 10.36% during that period, which in most years is a pretty good return. You can see that compared to the Morgan Stanley World Index, which is a possible measuring stick, our return was lower than that. But let me hasten to say, we have a bit of a different asset mix than that benchmark. The Appreciation and Income Fund, which is the sort of balanced fund equivalent, it's a mix of our aggressive equity products and our more conservative, less volatile fixed income product, had a return of 6.68%. Again, in the context of a long period of time, that's an excellent return for a balanced product. Again, somewhat trailing the mix in the benchmark, mostly again because of the underperformance of our mix of aggressive products compared to the MSCI. The pure income product, the more conservative of the three, had a return of 1.58% compared to its benchmark of 1.2%. And finally, the capital preservation product, the absolutely can't lose money, make sure that I'm always whole product, had a return of a modest 1.18% compared to the benchmark of 1.07. Let me say, by the way, that Chris noted that interest rates are on the rise as central banks around the world attempt to combat the threat of inflation. In the United States this week, for the first time in, I believe, 4 years, if not 5, the yield on the 10-year U.S. Treasury bill exceeded 3%. This is good news for our income-focused product and our capital preservation product. As yields on things like U.S. Treasury securities go up, the returns on these very conservative products will rise as well. Could we please look at the next slide? This slide talks about volatility. When I was talking about the quilt, I said that increasing diversification results in lowered volatility. To some extent, we view volatility as a proxy or as a measurement of risk. Certainly in the short term, volatility and risk pretty much are the same in the minds of owners of securities. If your securities are going down 10%, that feels more risky than if they're going down 3%. Over a long period of time, years, 5 or 10 years, volatility in the short run is much less important. What happened in February of 2018 will certainly recede from memory over time, and 10 years from now will have passed from memory altogether. But for our purposes, when we look at volatility, lower volatility is in fact equivalent in our minds to less risk. And what you can see from this slide is that all of our managed products are in fact less risky than their benchmarks. And although those numbers may not appear to be very large to you, in the world of reduced volatility, those are significant differences indeed. Lower volatility in the capital appreciation, the appreciation in income, and the income-focused fund, all of which means that we are fulfilling our goal of putting preservation of capital at least on the same footing, if not ahead, of getting the absolute maximum possible return. It means that to a certain extent, the investment committee has taken the decision to trade return for risk. This is the inevitable trade that every investment manager makes. How much risk for how much return? The investment committee and through it, the board of the RPB has always taken the view that our participants are prepared to sacrifice some return for lower risk over time. And what you're seeing in this slide is that lower risk playing out. Now, if I could have the next slide, please. I want to talk about the passive investments which have been available to our participants for, I think, just over a year now, if I'm not mistaken, Michael. Is that right? The passive.
Yes, David. These are the Vanguard index funds have been available since January of 2017.
Right. So around 5 quarters. Now, what these products do is very closely track defined indices. So on the far left, you will see the Vanguard S&P 500 Institutional Index Fund, which tracks the S&P 500, the most important and largest stocks in the US. And as you can see, it is within 2 basis points or 0.02% of the return on the S&P index at 13.97. The one beside it tracks a different group of stocks, smaller companies that are in the Vanguard small cap index, again, tracks very closely that index. And the third one is the developed world all cap stocks outside of the United States. This is the most important companies in the world that are headquartered outside of the United States. You can see that the return on those were quite good this year. And the other stock index is the emerging markets index, again, outside of the United States, I believe, the best return of all the equity indexes. And as we saw from the quilt, this is because emerging markets have done very well indeed in the last 12 months. The other products have less spectacular returns. The next one is the real estate investment trusts, a negative return of 4.5%. Typically, when interest rates go up, the returns on real estate investment trusts become less attractive to investors and they get sold off. The next 3 products, or 4 products, I guess, are all various fixed income products. One is basically the entire bond market. The next is medium maturity index, followed by Treasury inflation protected securities, followed by the short-term bond index. As you can see, the returns on fixed income continue to be quite unrewarding over the last 12 months. The tier 2 investments are doing what we expect them to do, follow their indices closely, and those participants who have put their money into tier 2 are getting what they expected. And approximately, if I'm not mistaken, 8% of all the plan assets are now in tier 2 investments after around 15 months.
David, let me jump in just to add that for the Reformed Jewish Values Fund, which only launched in January of this year, we only had 3 months worth of results, so we couldn't include this on a trailing 12-month chart, but wanted to just to share that that fund had a small loss of about 1.2% for the first quarter. If you saw the first quarter results for all these funds, you would probably see comparable results because it was as David talked about earlier, the volatility is back. Q1 results were very, very mixed. So the JVI fund was down slightly at 1.2%. I'm going to break protocol here. And while we typically reserve questions for the end, this particular question is very directly related to, David, what you just talked about in relation to our funds. So let me just read this one in particular, and then I will go back to protocol and save the rest for the end. So question, what is different about our mix of assets in the Capital Appreciation Fund versus the mix of assets in the benchmark for that fund? Are we still pleased with the mix of assets in our fund? David?
So in fact, I'm going to kick this one to Chris because we have taken 2 tactical tilts in the asset allocation of the Capital Appreciation Fund in an attempt to increase the diversification and in particular to hedge against inflation. So I'd like Chris to talk about that and the rationale for those picks.
Sure. So at a broad level, I would say, and David kind of highlighted, is that we are more diversified than just global stocks. So there are allocations, defensive allocations to kind of lower risk assets. So it is, once again, a portfolio of not just stocks, but is slightly defensive in construct. And you can see that on the volatility slide, those realized results are less risky as well as the benchmark. So there's some defensive positioning strategically. In addition to that, there are some what I would characterize as real asset allocation. So things that are over longer periods of time intended to do reasonably well in inflationary time periods, which are also in the portfolio. And then lastly, I would add that we have less currency risk than the benchmark. So we have more US dollar denominated exposure than the global stock benchmark. And then lastly, on the tactical side of the house is we have 2 things. One is as the market had become reasonably extended in the last half of 2017, we opportunistically, defensively added a little dry powder or cash allocation to be able to be redeployed if we saw a further market pullback. And then lastly is that somewhat similar to, I mentioned some of these growth stocks had meaningful outperformance. We slightly tilted away from what would maybe be called the FANG stock, these big tech stocks, which have driven the market performance and have reasonably full valuations to a little bit more of a value bias as well within the US large cap stock exposure.
Yeah, so if I can just add to what Chris said, one of the things to recognize is the effect of currency movements. And the results of a world portfolio can be skewed quite sharply by changes in the value of the US dollar against other world currencies. And the world currencies, of course, being the euro and the yen, the British pound, and the Chinese currency. When the US dollar is weak, foreign returns look particularly strong. When the US dollar is strong, foreign returns measured in US dollars are relatively weak. This was one of the results, or one of the things that impacted results in the trailing 12 months. I want to talk just briefly about the themes that the investment committee is focusing on in its work going forward. I think the most important of these has to do with rising interest rates around the world. The Federal Reserve Bank of the United States is at pains to explain what it's looking at and what its policy is likely to be going forward. And with its new chairman and new members, we don't see a great change in policy. The Fed is very concerned about the risk of rising inflation. Typically, when we see full employment, we start to see increases in wages. Increases in wages drives up the costs of goods and services, and inflation rises. Certainly in the United States, we haven't seen the impact of high employment causing higher wages to the expected result, at least not to date. But the Fed is very concerned about this and has pretty much telegraphed that it will be raising rates 2 to 3 more times during 2018. Their object is, again, to combat increased inflation by tightening the money supply. Their job is made more difficult by the fiscal policy of the United States, which will result in the federal government in the United States running massive deficits on the order of $1 trillion a year, as far as the eye can see. This basically, to a certain extent, nullifies the effect of tighter monetary policy, and makes the Fed's job quite a bit more difficult. So we do expect to see higher interest rates. Higher interest rates, again, will cause bond yields to rise, will make certain asset classes less attractive, but will also tend to make certain other asset classes more attractive. So the investment committee has its eye on this, and together with Summit may make some asset allocation changes, which will affect both the capital appreciation fund and in turn the appreciation and income fund as we go forward. Secondly, we, of course, like everybody else, can't help but notice the trade war rhetoric coming out of the White House. I can tell you, here in Canada, where the North American Free Trade Agreement is a very big deal indeed, people are very closely watching the negotiations in that deal, which affect an enormous volume of trade affecting Mexico, the United States, and Canada, as well as, of course, the job owning going on between China and the United States. We, I think I speak for the investment committee, as well as for about 99.9% of all the economists in the world, view trade wars as potentially enormously harmful to economic growth. We do not subscribe to the notions that trade wars are easily won or that they are a good thing. So we're very concerned about that. As the slide suggests, the actual implementation of tariffs and trade barriers has been more rhetorical than actual, at least to date, but we don't know how long that will last. And the final point on this slide that bears looking at has to do with valuations of stocks. Having gone up by approximately 300% in 10 years, many stocks in the S&P 500 are certainly fully valued or close to fully valued. Studies over time suggest that the valuation of stocks when you buy them is a major determinant of the return which you eventually achieve. So to the extent that valuations are high, the suggested returns on stocks will be lower, say in the next 5 to 10 years, than they have been in the last 5 to 10 years. This again suggests that asset allocation might be devoted to things other than the more highly valued stocks. And Chris will talk about that in a moment. And we'll return to the subject of how we see asset allocation, something called modern portfolio theory and the efficient frontier, as we reach the end of the presentation. So I'm now going to turn it back to Chris.
Thanks, David. So we have obviously spoken a lot about the last few months, the first quarter, and on a year-to-date basis. We wanted to take a chance to to maybe address things from a longer term perspective and what longer horizons, 5 and 10 year expectations might be, as well as how we think about those when we've built these kind of various portfolios. So currently, when we look at the equities valuation, you can see this is in particular, this is the S&P 500 is similar to what David just said, is the price that you pay for these stocks. What is the long-term result expectations with today's prices? And you can see from, so this green here is basically what is the expected 10-year return today is something close to 5%. So in the last 10 years, you can see the green line has marched down dramatically as the price has meaningfully appreciated faster than the underlying earnings. So when we speak of what are reasonable or base case expectations of stocks today, S&P 500 stocks in particular, a 5% type level is today's base case expectations. A lot of the good performance, this outperformance of double-digit returns that we've seen over the last few years has effectively been pulling some of those returns forward. So as we sit here today, we've already had the benefit of these longer-term returns, just we had them all at once. Similarly, if we look at fixed income, we see that even as recently as kind of prior to 2008, bond yields were often in the 4 to 5% range, meaningfully a decent cushion versus inflation. As we stand today, even with the backup in rates that we've seen on a year-to-date basis, we're closer to 3%. So if you think again on a longer 5 and 10-year horizon, this yield has been a pretty good proxy of what your ultimate realized results are. The bond portfolios, kind of vanilla bond portfolios, expectations are in this 3% range. US stocks in this 5% range. So a portfolio of just stocks and bonds gets you to these mid to low single digits, which is again what we've talked a little bit about historically as that this kind of muted return environment, this new regime that we've ultimately found ourselves in over the last 10 years. Going back to this, if we switch gears here to talk a little bit about just trying to separate kind of the signal versus the noise. And this is just kind of statistically, the graph on the bottom here shows that basically on various horizons, the price that you paid, how predictive is that of the actual returns that you realize? And you can see in kind of very shorter term horizons, anything inside of 1 year, the price that the stocks are trading at aren't predictive at all of these short-term returns experiences. But as you lengthen the horizon, ultimately that the price that you paid is the biggest driver of returns, where almost 90% of your 10-year returns is basically the price that you paid for those stocks. But over the short term, stocks can go from cheap to rich, rich to very rich, so on and so forth. The short term is often just noise and or is driven by sentiment, not valuations. To talk a little bit about portfolio diversification, I think some folks might have seen this before, but this is to some extent just highlighting the benefits of owning not just a single asset class, but is owning multiple asset classes and the diversification benefits. So sometimes in investing or finance, this is the one free lunch in markets, is that not everything moves lockstep with each other. Sometimes things zig and zag, and you get a risk reduction benefit by having a very diversified portfolio. That's this on this representative graph here, that the fact that the blue diamonds are above the this blue dash line, meaning that that incremental diversification benefit is that the space above the line. If we were to, so that's kind of in principle with two asset classes, but in addition to individual asset classes and thinking about diversification, we want to also, when we think about these portfolios, also diversify across the business cycle. Different parts or different allocations in the portfolio are designed to perform better depending upon which part of the market cycle that we're in. We've been in one of the longest extended market cycles in US history, but to some extent there's some things in the portfolio that are there for these late cycle as an example. So you can see there's three large kind of stylized parts of the cycle: the early cycle, mid-cycle, and late cycle. And these have pros and cons for both the macroeconomy, kind of represented here by economy and inflation, and as well as the major asset classes, kind of stocks, bonds, and kind of a traditional portfolio. As we're almost 10 years away from our last recession, almost all market participants would think that we're somewhere most likely in the late or end of cycle. And you can see that this is often not a great place for financial assets, where we've had this huge benefit of a long extended mid-cycle, which has been, you can see, good for stocks, good for bonds, and is very good for a kind of a traditional portfolio. As we move into the late cycle, we often see inflation to start pick up, the economy start to falter, and stocks and bonds start to becoming less additive at this part of the cycle. So when we think of kind of the offset to this is on the next page, is that when we build a diversified portfolio, we want to have diversification not just in asset classes, but across this business cycle. We also often will introduce this notion of real assets. So whether those are commodity-centric equities or commodity futures, real estate investments, things that historically have had a beneficiary of a rising inflation environment. And if you were to break the business cycle down into kind of these 4 different quadrants, you'll see each asset class, or there's an optimal portfolio for each of one of these 4 different environments. So rising growth, rising and falling growth, rising and falling inflation. You can see that we've often been in this rising growth and falling inflation environment. So box 2 has been where we've been living in for the last few years. And you can see this is just the historical experiences that stocks and bonds typically do very well in this environment. This is when they shine. And so in that world, we've had a very positive experience for most portfolios. But as we potentially look at a rising inflation, these box 1 and box 3s, you can see that stocks and bonds often struggle in this particular regime. And that's where real assets and an allocation to some of these diversifying strategies earn their keep in the portfolio.
Right. So if I can just add to that, this does not mean, by the way, that it's prudent to go to zero weight in stocks. One can never be too sure where one is in the business cycle or how the markets will perform. So we're certainly not suggesting to participants that it's wise to look at these 3 boxes and say, well, if we're in the lower left-hand quadrant in box 3, where we expect to soon see falling growth and rising inflation, we should sell all of our stocks and put all of our money into bonds and real assets. By no means are we suggesting that. But I will tell you that the investment committee has moved 10% of its money out of growth equities, putting 5% of it into value equities, which tend to have a lower valuation per dollar of earnings, and 5% into cash equivalents in anticipation of better returns on assets other than stocks as we move forward. And we've also added, as I said, these diversifiers that Chris mentioned, which are real assets, which we believe will probably do better in the next few years. Now, as anybody who's ever been involved in capital markets knows, nobody rings a bell to say we've now moved from quadrant 3 to quadrant 4, or from quadrant 2 to quadrant 3. Judging where we are in the business cycle, judging how markets will move is extraordinarily difficult. That's why our asset allocation changes are on a fairly small scale and are done over time and gradually.
And also to kind of continue to add to that is that both the capital appreciation in isolation as well as the income focused fund have some allocations to these 3 large asset classes in various weights strategically.
So if I can sum up what the investment committee sees for our participants in the next little while, I think it's fair to say that the returns that we've had from the stock market over the 10-year, well, I guess 9-year period from March of 2009 to March of 2018 have been extraordinary. Certainly, they shouldn't form the basis of anybody's expectations for the next couple of years or any long period going forward. That came from a very low level, and they've really been wonderful returns. We do expect to see higher interest rates going forward. This rewards savers over time. One of the interesting things that's happened over the last 5 years in particular is that borrowers have been subsidized by savers. The very low level of world interest rates has essentially mean that the owners of capital, largely older people and savers, have been loaning money to younger, less wealthy people at bargain basement rates. That's about to change. An upside surprise is always possible. Nobody knows what's going to happen next. Nobody can tell how the world will change. There's lots of things going on, any of which could provide an upside surprise, but also downside surprises. For our participants, it's always important every year to review time horizons and risk tolerances, and as one's financial needs and requirements change, to look at their portfolio balance and to make changes if necessary. And finally, and I think this is maybe the most important point of the entire presentation, no market movement can contribute enough to compensate for a lack of consistent savings over time. Contribution rates to the pension plans on a consistent basis over time, which provides the immeasurable benefit of compounding, is far more important than the returns from year to year. And needless to say, the ability to control spending is outside of our purview at the investment committee, but to a great extent is within the power of our participants. And the measure of happiness, as Dickens said, is to earn 20 pounds and spend 19 pounds and not the opposite. Michael?
Thank you, David.
Why don't I close with our usual Q&A. Now, in our last session, incidentally, we introduced our groundbreaking Reformed Jewish Value Investment Fund. You may find it of interest that our partner in the development of this fund, the Imperial Group, has planned to introduce this concept to a number of their institutional clients, which will take place over the next few months. In fact, Michael is going to be a speaker at one of these panels, if you will, in New York, and we think the fund will get a lot more publicity. Now, Imperial Group, as well as we, are excited about this new addition to our Tier 2. Michael gave you the performances. Questions regarding the JVI are certainly appropriate at this time, as well as our normal questions on the presentation. Michael, one more time, would you just remind everybody how to log in? We're getting a few questions, but just
Sure.
to make sure everybody's got a handle on it.
Absolutely, Len. So as I mentioned at the outset, at the bottom of your screen, right in the middle, there's a little Q&A button. You could just click on that and log your questions, and we see them on our side. So with that, we really just have a few questions that have come in so far.
Yeah.
We've answered one, but happy to answer.
All right, we've got one here. Please tell me the average choice of investment for someone like me, age 75 and a half, just over the speed limit. Also, may I place part of my appreciation and income choice into the Vanguard Index Fund? Thank you. Michael, why don't you start with that one from the administrative side?
Sure. I don't have the exact averages for those at my fingertips for someone who is 75 or so years old, but I will say that if I would venture to guess when I would look that up, that the majority of the folks in that age bracket are probably more conservatively invested, probably more heavily weighted in the income-focused fund, which is our primary income-oriented investment, which has mostly bonds in it. I'm sure that there are some that are still in the appreciation and income fund, which is our balanced fund, with the opportunity for additional growth. But my guess, and based, if my memory serves me correctly, I would say most folks are skewed towards the income-focused fund at this point. Now, for the second part of your question about placing part of your, it sounds like this individual is in the appreciation and income fund, and can they move some money into the Vanguard index funds? The answer is yes. Every participant can invest any percentage of their account in any of our 14 funds. If you were interested in, for example, shifting some amount of money from your appreciation and income fund, or a certain percentage-wise, to any of the Vanguard index funds, all you need to do is log on to your account through Info Express and make those allocation changes. If you're having trouble, please contact the office. Robert Perry, myself, Nabila Hossein, any one of our folks here in the office can help with that. Next question, Mike.
Yeah, and this is a great type of feedback that we like to hear, and they want to know what would be helpful in future sessions that focus on different age groups. We've been discussing with, I've been discussing with Stephanie and Michael to have a retirement readiness group for those who are truly within a par 5 of retirement, and how that might be handled. So we are absolutely sensitive to that. Is it better to be cohort managed rather than general? And we think that this is exactly where we are going, and I think you'll be seeing the results of that in the near future. Another wants to know, do we have a number of gun manufacturers among our investments? Anybody want to take that?
Yeah, I'll take that one, Lenny.
David.
So one of the reasons we created the Jewish Values Investment product is precisely because of questions like this. When one of our participants buys the S&P fund, if one of the gun manufacturers happens to be in the S&P 500 index, they get, whether they want it or not, some fractional ownership of that company. And similarly with the world equity products. The purpose of the JVI, of the Jewish Values Investment, is to allow us to invest in a large universe of stocks that have been curated to filter out companies that we or our participants don't wish to be in their portfolios, and that would include gun manufacturers. So to the extent that you have concerns about those kind of issues, that's why the JVI is there. Certainly if you buy an index product, you may end up with a number of companies that you don't like, including guns and tobacco and gambling, but we have a cure.
Let me just add to that. Glad that Michael and I both sat on the JVI formulation committee, chaired by other members of our board, Howard Shapiro as the full chair. One of the things we are doing, and please keep in mind, those where we have managed funds, such as in Tier 1, we have direct impact into their choices, at least in terms of guidelines. And we have taken the JVI concept and promoted that to all of our managers where we can. I want to reiterate what David said because it's a key point. If you go into an index fund, we have no say in how those funds are invested. You buy the index. So if that's what you're concerned about, please keep that point in mind. One other question. Michael, do you have anything to add on that?
No, the only other thing I'll add is that, just as a reminder, so there are a couple of advantages to owning the stocks outright. As David mentioned, the Reformed Jewish Values Fund, we own the underlying stocks, which that means we get to choose which kinds of companies based on the let's say the business they're in, handgun manufacturers, for example, we get to screen out. The other thing, and this applies to not only the RJV fund, but also the managers in our Tier 1 funds where we own the stocks. There are still a couple of managers where we do own the stocks. We get to vote the proxies. So that means we get to apply our values through what's known as shareholder activism. and we get to vote our values to the companies that we do own. So I just wanted to reiterate, not only are we screening out companies that we may not like or agree with the kind of businesses they're in, but we actually do get to vote on any number of shareholder resolutions for the companies we do own.
Please understand we are taking this very seriously. Another question has come in. Any suggestions on how best to manage one's investment portfolio when you are retired and we are experiencing a volatile market? Hopefully this seminar went toward that. Mine is in the income fund, which seems pretty safe from the present market fluctuations. Is that true? Perhaps Chris or David, you can reiterate the points that were made. If you need a chart, we can try and pull it up to where the income fund versus the volatility to help the questioner.
So I would say two things, and let me say that this is what I do for a living, and I have many participants in their 70s and 80s and 90s, and as we get older, our attitude to risk necessarily changes. Certainly, post-retirement, the ability to replace funds that are lost through adverse market action is sharply reduced, and therefore it's appropriate from that point of view to reduce risk. But I think it's important to understand that short-term market volatility is not at all the same thing as the risk of a permanent loss of capital. Very few of our participants are in a position where they're going to seek to take out 100% or 50% or even 20% of their capital in any short-term period. So to that extent, a short-term market fluctuation, although unpleasant and can certainly cause loss of sleep, doesn't necessarily cause any lack or any real financial pain in the long term. But at the same time, we must recognize that most of us are living longer than our parents, and certainly longer than many of us expected to live 30 or 40 years ago. And that raises a risk of its own, which is that if one becomes too conservative too soon, to the extent that the returns on bonds are still very low, one can in fact use up one's money and still have years of life remaining. So when I speak to my clients, we're always seeking to balance those two things: their increased longevity and therefore increased need for money for a longer time with the fear of market fluctuations. My own view is that probably the greater risk is that we'll live longer than our money. And of course, that means that we should probably take more risk than we might have 20 or 30 years ago. Chris, I'm sure you've got something to say on that too.
Yeah, I think you kind of hit on that. It's this balance between income and return generation needs versus, kind of certainty. And if you take it to the extreme, the Capital Preservation Fund provides, a reasonably riskless option, kind of a guaranteed against loss. But you can see on the kind of the cost of that has been a percent-like returns for a long extended period of time.
For those of you, thank you, David and Chris. For those of you, certainly we recommend speaking with a financial advisor if you have one. If you don't, or even if you do, you're always welcome to call LifeWorks, which is our partner organization that provides financial counseling. They may be able to provide you with a little bit more direct guidance and direction in terms of how you might want to allocate your portfolio based on your individual circumstances. Right. Thank you, Len. Len just reminded me, we could try to be as direct as we can, but we can't give you specific investment advice, tell you this is what you should do or how much you should invest in X, Y, or Z investment. Ceridian could be a little bit more helpful in that regard. So certainly, LifeWorks can be helpful in that regard. So I do encourage you to speak with them at your leisure. Again, the service is free. The information is on our website under education and resources. And so you could check them out. So seeing no other questions that have come in, I think we will wrap things up. I wanted to thank Len for coming in and joining me in the city today to moderate our discussion today. As always, David Baskin, Chris Moore, thank you two very much. And to all of those who've submitted questions, thank you for very thoughtful and insightful questions, and for everyone's attention through our 55-minute presentation. Anyway, enjoy the rest of your day, and we'll see you next quarter. Take care. Bye-bye.